Happy Halloween and welcome to this Monday, October 31st, 2022 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes featuring everything you need to know as you prepare for the trading day ahead. Well, it's going to be an interesting week. We're wrapping up a strong October. Futures are a little bit weak this morning, so we're going to see how much of the gains we can hold on to, or maybe we get another afternoon rally. We've seen some morning gap downs, especially on the NASDAQ, followed by some buying intraday. So we'll see whether or not that takes place. But it's going to be a very, very interesting week as we go forward, because we do have the Fed meeting Tuesday and Wednesday of this week. The policy statement will be out on Wednesday afternoon at 2 p.m. Eastern. We've got the ADP employment report coming out on Wednesday. We've got the non-farm payrolls out on Friday. It's going to be interesting to see how the market reacts. This is one of the best weeks of the year historically. We got off to a great start last week. I've talked about how it's really strange, but the stock market tends to perform really weak from October 21st close through October 27th close. It's the worst week of the year historically since 1950 on the S&P 500. And then literally the next week to 10 days is the best period since 1950. So it's like turning off the cold water and turning on the hot water at the close on the 27th. And we saw that last week. The NASDAQ in particular were struggling. And then all of a sudden Friday hit and it's like blue skies and green grass everywhere. The market did extremely well on Friday. A lot of strength throughout the day, a trend day, I like to call it, where the market basically just went up all day long. Is that going to be the precursor for what we're going to see the rest of this week? I don't know. We've got some key overhead resistance. So there's a lot of stuff going on. But this morning, futures are pointing to, and we still have another 30 minutes to go before we open. So, but right now we got the Dow Jones futures down 162 points. The S&P 500 futures down 21. NASDAQ futures down 80. Crude oil prices down $1.40 this morning, down to about 86.5 a barrel. So that's down 1.6%. The 10-year Treasury yield, that's going to be a big story this week. Well, it's been a big story all year, but it's going to be a big story this week for sure with the Fed meeting and all. But 10-year Treasury yield right now up 4 basis points to 4.05%. Technically, it's a big week for the 10-year Treasury yield as well, because we have seen that pullback to test the rising 20-day EMA, which is where it has found strength and support in the past. And when it's turned off of it and gone back up, we've had problems. Let's not forget, we've got CPI coming out in just another, I think it's 10 days or so. It's not this week, but next week. So we got the inflation reports coming back out. If there's two things that have really hit the market hard in recent weeks, it's been Fed announcements and inflation reports. We've seen some of the biggest drops recently when those occur. So I don't know, what is Fed Chief Powell going to say after the meeting on Wednesday? I think just about everybody acknowledges it's going to be another 75 basis point rise. I think either any change from that, any kind of variance from that, I think would really maybe drive the market crazy in either a bad way or a good way. I think if they were to suddenly say we're going to go to 1%, I don't think the market would handle that well, at least not in the short term. Market's more concerned about what they do down the road. But in the short term, if Fed Chief Powell drops another bomb, the market will probably handle it the way it's handled the last couple of bombs, which is not good. If, on the other hand, they decide to only go 50 basis points, I think that would be a major boost for the stock market, or even in the language. You know, depending on what kind of language he chooses, I think that could be really important. And that'll be at 2 p.m. on Wednesday when that policy statement is released. All right. Before we get into things, let me take everyone over to earningsbeats.com. If you are unfamiliar with Earnings Beats, if this is the first time you've been listening to the show, welcome. Certainly appreciate everybody tuning in. Make sure you let your friends and family know we're here. Love to try to help as best we can, at least give you my opinion on what the market's doing, where I think it's going. I may not be right, but I'll give you my opinion based on what I'm seeing. Anyhow, Want to mention a couple things here at the website. Number one, we have a huge event coming up this Saturday, understanding market manipulation. I've talked about it. I've written about it. I believe, based on all the signals I'm seeing, we are going to have a big, big rally ahead. Big rally ahead. Let me repeat, big rally ahead. But we've got issues we're still dealing with in the near term. I think the Fed could really hold the key to unlocking a major rally in the stock market. If they start to turn dovish at all, if they just suggest that they're going to pause, or that they think what they're doing is working, and that they're probably going to do, maybe have a 50 base hike in December instead of all these 75, or maybe even that they're going to be more data dependent. They're starting to see some good, anything that's positive. I think you could see this market melt up. Just based on what I'm seeing in the rotation, I think Wall Street's already moving into aggressive areas. We're going to talk about this on Saturday. It'll be, if you're not, understanding what's been taking place in the market, and you always feel like you're one step behind, you need to come to this webinar on Saturday. It's a free virtual event. It'll start at 10 a.m., but you need to register. Those of you that are Earnings Beats members, you do not need to register. We will take care of you. We'll make sure you get room instructions. But if you are not currently an Earnings Beats member, you want to make sure you register for that event. We do have limited seating, so you want to make sure you're registered in time. The other thing I want to mention too is, even if you're not interested in the Saturday event, we do have a free Earnings Beats Digest newsletter. It comes out 3 times a week, Mondays, Wednesdays, Fridays. Quick read, couple paragraphs, a chart. I featured this morning one of the best looking bank charts that I've seen out there. That was featured this morning. These are the types of things that we like to look at. Things like relative strength, earnings, gaps, candlesticks. These are the types of things that really interest us. And I think we can help in your trading. But this is another free newsletter, by the way. Name, email, address is all it takes. You can unsubscribe at any time. No credit card required. This is an opportunity for us just to give back to those of you who do support us. We'd love to help out. So make sure you sign up for that EB Digest. All right, so let's move on. What happened on Friday? Well, it was a big, big day. And I don't know if you've noticed, but wow, I mean, the Dow Jones has been on fire. I would prefer seeing the NASDAQ on fire relative to the Dow, because this is a little bit safer index. I want to see, if we're going to really get into a bull market, or get back to that secular bull market and see another big advance, we need money rotating into the more aggressive areas. That's what's holding back the NASDAQ right now. You've got semiconductors, software stocks, and internet stocks. There are others too, but those are 3 key groups that have really struggled on a relative basis. Software setting new lows recently relative to the S&P 500. Internet stocks last week crushed. Meta Platforms, ugly report. There were some others too. Snap can't get out of its own way. There were a couple of not bad reports in that area. Pinterest, I thought, was pretty decent. Got back up above its 50-day moving average. So there are, pockets, but overall, it's semiconductors, software, and internet stocks. And they're high growth areas. They are highly dependent on, well, not highly dependent, but their valuations are fairly dependent on what interest rates are doing. Even if their earnings are going up, if interest rates are going up, that's going to eat into their valuations. Same thing when earnings are going down. If the Fed pivots, you're going to see some of these companies come back to life very quickly. So a lot of people are writing about technology being dead. Technology is not dead. It just needs a little bit of shock treatment from the Fed. Fed needs to turn a bit more dovish. Until that happens, it's going to be difficult for that area of the market to really take off. So the first thing I look at is, when I'm looking at these indices, I'm just seeing the Dow clearly the outperformer. We're getting back not too far from the August high, and this has come pretty quickly. We were at a new low just 2 weeks ago, 3 weeks ago, and now we're getting back close to a multi-month high. So it's been a very, very strong month in October for the large mega cap Dow Jones component stocks. The S&P 500 doing better than the NASDAQ. We're now back above the 50-day. Also, it wasn't that long ago we saw this positive divergence, higher PPO, lower price. We said 50-day moving average, that's the most probable outcome. Well, here we are. We've gotten back just above the 50-day moving average. And also we know from prior tests and from prior support levels, this has been a big area. 3,900 has been a huge area in 2022, both support on the way down and resistance on the way back up. So we're sitting at 3,901. We got red futures. Watch that rising 20-day moving average. I think that's going to be the key on our major indices. If we move back down below the 20 days on all of our major indices, then you've got to be willing to accept that the recent lows could come right back into play. But as long as we trend above the 20, we're in an uptrend. So short term, the daily chart to me says we're in an uptrend. We're in the most bullish period of the year historically. And the Fed's got an opportunity this week. And listen, the Fed's not trying to boost the market. It has in the past. It's not. It's actually trying to bring the market down to stymie inflation. So the Fed is not exactly working on behalf of the bulls right now. But you do reach a point after a number of these rate hikes where, I think they're going to be coming to an end or at least a pause to see what kind of an impact all of these large rate hikes are having on our economy. The NASDAQ, like I said, struggling a little bit. It was up the most on Friday. And this is part of that manipulation thing I've been talking about. I don't know if you noticed, the NASDAQ opened as the worst index on Friday. And by the time it closed as the best, meaning that weak opening gap became a very strong rotational force during the day. Money rotated very strongly toward the NASDAQ during the day. And that's been happening a lot since June. And this will be one major area of focus in the Saturday event that we have coming up this Saturday, November 5th. Mid caps, small caps, both up nicely. Mid caps a little less than 2%, small caps a little over 2%. I'm also watching these AD lines to see whether or not we can break back out to new highs. I think they're hanging in there pretty good. In prior secular bear markets, I'll always get comments, well, what would make you think it's a secular bear market? What, you keep talking cyclical, short term. What would make you think that this is going to last longer? One significant technical sign would be the AD lines falling apart, moving back down, because that would be much more indication that there is selling during the day rather than these gap downs. Gaps, markets don't just go, institutions don't put market orders in for 1 million shares at the opening bell. If you trade the market, if you look at the market at all, the market is not liquid at the open. You could put 100 shares out there and you're not sure where you're going to get filled. You're not going to put up 1 million shares at market to open. Institutions do not buy and sell at the opening bell. You've got to, that volume has to be spread over a period of time, and it has to happen during the trading day when there's a lot of liquidity. One way for market makers to gather shares for their institutional clients is for the news to be bad, to have gap downs, people panicking, selling out early in the day so that they can buy cheap for their institutional clients. We saw it at the top. Same thing in reverse happened at the top. We were seeing gap ups in December, followed by intraday selling. That's how Wall Street was positioning out of consumer discretionary and into consumer staples. Wall Street stock market was an ATM machine back in December, January. Couldn't lose money, just go long in anything. That changed. We needed it to change, and it changed. Now we're at the other end of the spectrum where everybody you talk to thinks we're about to crash. Well, I got news for you. We pretty much did. The NASDAQ was down 35%. A lot of this is built in, and now we're seeing rotation back into aggressive areas. Telling you, Wall Street is preparing for the next advance. You may not be, but Wall Street is. We'll see what happens. From a sector perspective, technology, utilities, communication services, financials, those were your four leaders. 11 sectors out there, 11 sectors higher on Friday. Discretionary went up, but this was your weakest performer, barely up. So discretionary really didn't participate on Friday, which was somewhat concerning, but at the same time, very understandable if you know that the XLY is comprised of two stocks that are about 45% of that ETF. One of them is Amazon. Amazon had a rough day on Friday after posting earnings that fell short on Thursday after the close. So you got Amazon, which really held back discretionary. They came up quite a bit off their lows, by the way. So there was a lot of intraday buying, but we finished weak because we started horribly. Anyhow, let's move on. 10-year Treasury yield. Well, we've got a lot of news coming out later this week. This morning, we've got the October Chicago PMI coming out. The expectation there is 47.3. September was 45.7. So we're looking for a little bit of improvement there. Tomorrow, the Fed meeting begins. Wednesday, of course, we're going to have the Fed meeting ending. Policy statement out at 2 p.m. 75 basis points. I think that's what's widely expected. Market has that priced in. So it's only if the Fed varies off of that would I see a major reaction. And when I say major, I'm not just talking about for an hour or two. I'm talking about maybe for the next few weeks. And if they come out and say anything, or if they surprise with only a 50, I think the market explodes to the upside. And I think you're going to see software, semiconductors, internet, those stocks that have been beaten down, nobody wants to touch them. They will quickly come to life once the Fed gives any signals whatsoever that rates are either, they're going to pause the hikes or that they see what they're doing is working. Anything like that, I think would work out pretty well for those beaten down tech and consumer discretionary and communication services areas. Also Wednesday, ADP employment report, and then Friday we have the October non-farm payrolls. Non-farm payrolls on Friday expected to come in 210,000. September was 263,000. So we're expecting a little bit of a drop. One thing that would really, in my opinion, hurt would be if jobs were 400,000. Normally we think that's great. Well, it's great if inflation's going back down. The problem is if the economy appears to still be strong and strengthening, or even potentially strengthening, that's going to keep pressure on the Fed to hike rates. Because we don't need additional demand with still some supply chain issues out there, because that's what's driving inflation higher right now to begin with. We don't need more of that. So I know it sounds weird, but I think the stock market would love a slightly weaker than expected report. So if number's 210,000, personally, I'd like to see 100,000 or 150,000, something that's less, but it's not too bad. I don't want the market, or the job market to be completely falling apart, but I want to see it weaken. All right. But looking at here's that pullback I talked about. So there's your 10-year Treasury yield. I can give you an update on today, show you where we are right now. So we were bouncing a little bit. We've put in a higher high. That's the first time in about 6 days. We've been moving lower for the last week, a little over a week. And so today it looks like we're starting to move back up. I think whatever happens at the Fed meeting next couple of days and the impact on the 10-year Treasury yield, this right here, if we break that 20-day to the downside, we have a negative divergence. I think we could take a quick trip back down, maybe to 360, 365. If that happens, I would expect the NASDAQ to lead a big rally. Of course, then the other hand, what happens if the Fed says, hey, we're sticking to our guns here. We're not seeing inflation really checking as much as we'd like to see it. And as a result, we're staying the course. We're going to be rate hike. We're seeing another rate hike of 75 basis points in December. You start going along those lines and the 10-year Treasury yield jumps again, all bets are off. And I know this is historically a bullish period, but listen, market is not exactly in a good spot right now. We've been strong in October, We're back up, testing some key overhead resistance levels like 3,900 on the S&P 500, but we are certainly not out of the woods. So let's pay attention to what happens here, and also the CPI report next week, which I think is November 10th, but I'd have to double check that. So that would be next Thursday. Not this Thursday, next Thursday, 10 days from now. All right. Let's keep moving. So the S&P 500, there's your 3,900. And if you're wondering what the heck I'm talking about with all these support tests and resistance tests at 3,900, well, there you go. On the way down, double bottom bounce, went back down, tested it. That then became a gap resistance area after gapping down. We go back up. We got up to about 3,920, I believe, or 3,921. Back down again. Then we went through up to 4,000, back down to 3,900. That's where we made the big move into mid-August, back to 4,300. Came back down to where? 3,900. Back to 4,100, 39, back through. And now look at us right back up here at 3,900. So this has been now going on for 5 months. Up above 3,900, below 3,900, above, below, and now we're right back at 39. Which way are we going? It's a good question. I don't know. I think, I've been shocked by the Fed. I was shocked right here by the Fed. The market is watching the Fed closely, the 10-year Treasury yield, and the CPI, these inflation reports. This right here, September, this was your September CPI. Look at the big move down. Right here, you see this big recovery. This was the September CPI. This was August CPI reported in September. This was the September CPI reported in August. We had the gap down. It looked like we were going to fall apart. And then the market, out of nowhere, huge recovery intraday. And since then, we've been going up ever since. This is big. These next 2 days are big. I think we could get through. If we get through 3,900, we could see a really big rally into year end. If the Fed cooperates, we'll see. I don't know what the Fed's going to do. No matter what the Fed does, I will remain bullish longer term, unless the market falls apart and these ratios I'm looking at, the intraday selling favors the more value-oriented stocks, and we start to lose support levels of many of the ratios that I've showed you in the past. That's the only way my opinion is going to change. But the Fed might delay the rally. I think this rally, I believe, was for real. I think it was that Jackson Hole speech right there, which threw the market for a loop and took us down one more time. So is the Fed going to do that? Are we going to have, another crazy CPI report? I don't know. I think if we do, probably go back down and test those lows. But first things first, right now, watch that 20-day moving average to the downside. Here's the NASDAQ 100, has not been nearly as strong. We have not gotten back up to the 50. One thing I did say, though, and this is a bullish pattern coming down off of this move, bounced left shoulder, moved down. That's the inverse head, moved back up and went slightly higher, putting in a slightly upsloping neckline. Back down last week, print a potential right shoulder, and now we're coming back up. And again, futures are down this morning, so we're going to see what happens. But if we can get through that neckline and the 50-day moving average on the NASDAQ, it could be big. I mean, this could be the last hurrah. This, to this morning's gap down, the Fed meeting, depending on what's said, we may have seen the bottom and we may be shooting higher out of this. I'm hopeful, but just be careful about putting too much, money on hope. We need to see it. If we get through, if we have a solid Fed announcement and the CPI numbers just come in, somewhat tame, we got a lot of room to the upside. I'm not worried about necessarily being in, when we go down, we catch the exact low. I mean, I actually did say that back in June. I felt pretty strong about that June low, and we did go up for a couple of months, ultimately coming back down and going slightly beneath that low. But if you look at a lot of major market bottoms, you will see a lot of times one last low that eclipses the prior low before you take back off to the upside. I mean, if you go back and look in the secular bear markets, I mean, we could pull up, let me show you. Look at this secular bear market low in 2009. We went down and took out the low from 2002. How about back in the 1970s? This low takes out this low. So a lot of times, then we had the pandemic taking out the prior low from 2018, which was the trade war low before we went back up. 2016, remember all that consolidation where we went sideways here? 2014 into 2015. January of 2016, we actually put in a slightly lower low than those prior lows before we took off. So I don't know if that's what's going on, but I do know historically, I've seen this plenty of times where you get that last low and it looks like, well, just going to give up. Here we go, new lows. And that's when the market turns. I don't know if that's what's going on, but we may find out later this week. All right, a couple other things I wanted to mention. Industrials. Look at the relative strength. This is the XLI : $SPX. So this is how you show relative strength on a chart. So you can take any two symbols. I don't know why I would, but I could take Apple and compare it to Chipotle if I wanted to see which one's performing better. It's just one symbol divided by the other. So if the S&P 500 goes up 5% and the XLI goes up 5% over a period of time, we'll just go flat. But if the S&P goes up 5% and the XLI goes up 7%, that tells you the XLI is outperforming. And on this chart, you'll see it by this line going up. So look at industrials, strong outperformance. Look at financials. This is the last 3 months. Money rotating heavily into financials. Money rotating heavily into industrials. Does that sound like a bad market to you? I mean, if we're talking about a major recession ahead, these rate hikes damaging our economy severely, we're going to have a really deep recession. Why in the heck would you be buying banks, financials, industrials? I mean, industrials, if there's one group that really is tied to our economy, it's the industrials. You ship goods. You manufacture goods. Why are we going straight up? This doesn't just tell us industrials are going up. We know the market's going up in October, but this is telling us industrials are crushing the S&P 500. This is what I'm talking about in terms of rotation. Wall Street, those big firms, they've got the market makers. They're buying for their institutional clients, and they're buying industrials. That's a little odd. Anyhow, look at the seasonality. And by the way, I'll be getting a seasonality report out for Earnings Beats members later today. I got a chock full list of reports to get out. So it's going to be a busy day. That weekly portfolio report, which I normally publish on Sunday just for our Earnings Beats members, just ran out of time last night. So I'll be getting that out today. I'll get out the seasonality report, of course, our daily market report. So there'll be plenty. Got a couple more chart lists. I'm going to be trying to get those out. We just sent out last night, and they have been updated this morning. So you can go to our website now and you can download our strong earnings chart list and our strong future earnings chart list. Both of those key chart lists have been updated through Friday's earnings. So they are now up to date. Anyhow, move back here to the seasonality. Here are the industrials. Now, this is the last 5 years. Now, of course, November 2018 to 2022, we don't know anything about November 2022 yet. So it's only been 4 years for November. 3 of the 4 years, though, 75%, they've been higher. Watch as I move back on this slider and go back. There's 6 years, which is really 5 years. And the XLI has been up 4 of the last 5 Novembers, 80%. Watch as I draw this back. every year. Look at that percentage going up every single year until I get to the 14th year back. So basically, of the last 14 years, of course, we don't have November of this year. So the last 13 years, 12 years of the last 13 industrials have gone up. Watch this one. So now we've got industrials relative to the S&P 500. Let's go back 14 years again. The industrials have outperformed the S&P 500 12 of the last 13 years as well during the month of November. It's pretty solid. You want to see what financials do in the fourth quarter? Here we are. October, November, and December. These are the average returns for the last 10 years down here at the bottom by month. So if you add up the first 3 months for the first quarter, you get minus 0.2%. If you add up the next 3 months, second quarter, you get plus 2.4%. If you add up the next 3 for the third quarter, you get plus 2.0%. If you add up the fourth quarter, you get 9.4%, the average return on the XLF over the last decade since this secular bull market began. So I think, was it here? That was here. So this is 2013 right here, by the way, on this 100-year chart. See how we took out that double top in 2013? That confirmed the new secular bull market. So when we're looking at the last 10 years, what I'm showing you is that during this secular bull market run to the upside, financials have been a powerhouse in the fourth quarter. And if we pull up the XLF, look at October. We started down, what, 30 and a half, 30, 40, something like that. We're up 10% on the XLF so far this month. And it's down a little bit, but not much. Let's see what, I like to just pull up a really short term, see what's going on here. See what the QQQ is doing. Well, we're down a low right now, down about almost 1%. Spider down 0.7%. And the diamonds or the Dow down 0.53. And your 10-year Treasury yield right now is up 5 basis points. So once again, the rising 10-year Treasury. Let's see if we get through 4.06. That was a high back on Thursday of last week. And that was also a low on the way down back on Wednesday of last week. So we've got a little history right in here at about this 406 level. If we break out, I would expect probably some more selling this morning. But what do we do tomorrow? Or even what do we do this afternoon? What do we do tomorrow? What do we do Wednesday? What does the Fed say? Jobs reports coming out. This is going to be a crazy week. And historically, the best week of the year. I'm not sure what to make of it, but I can tell you money is rotating towards aggressive areas. It started back in June, actually May, June. And even though we went back down, went slightly lower in price, remember, January of 2022, we went slightly higher in price. Money was rotating to defense. We know what happened. Now we got the opposite. Just put in a lower low on the NASDAQ and the S&P recently. Money's rotating more aggressively. I think it's going to lead to a big, big rally. We'll see. Anyhow, that's it. Let me take you over to the home page, your dashboard. You can see right now Dow down 114, S&P down 22, NASDAQ down 87. Don't know if you've been following the VIX. The VIX has been under a lot of pressure to the downside, which is good for equities. It is up this morning, 4.5%, back up close to 27. But my theme for today is how do we close? Because this has been a common theme recently. I'm talking about the last few months. Gap downs. People are, we're all psychological animals, really. I mean, when it gets down to it, you got your money on the line. You see a gap down, you're losing money. What's the first thought? I better get out. Can't take any chances. And so you sell. And when you sell, guess who buys? Market makers. And they can buy, continue to buy shares cheap. And then I hear a lot of people talk about, what about these dark pools? You know what the dark pools are used for primarily? For market makers that have accumulated shares from scared retail traders. And then they've accumulated shares for their institutional clients, and they transfer those shares in these dark pools, which I actually think is good, because otherwise you're double counting shares that are being sold and bought. Because market makers are buying from you and me when the market's going down, and they're selling to institutions. It's really just one transaction. It's from us to the institutions. But market makers are in between. So I like the fact that a lot of this volume is taken out of the regular market, because it's just double counting, which I just don't think provides us anything that's useful. Anyway, that's it. So let's go ahead and wrap this up. I'll be back tomorrow over at Stock Charts TV for your next episode of Trading Places Live. That'll be Tuesday morning, 9 a.m. So just simply click on that link at 9 a.m. You can listen to it. And please sign up, register for this event this Saturday. I'm going to show you what I'm talking about in terms of this manipulation and how this rotation is setting up for a big move to the upside. You need to learn about this stuff. Saturday morning, 10 a.m. Hope to see you there. Happy trading, everybody.